Nigeria's Debt Management Office is scheduled to offer 80 billion naira in its November bond auction today. And I have Akpevwe Oputu. She's a fixed income dealer at Access Bank. She joins me now to tell us what to expect from the auctions and more. Thank you so much for your time on the show, Akpevwe. Before we get into the bond auction, though, I would like to understand what the sentiment has been in the market this week.
Thank you very much for having me on this show, Kenneth. So in the secondary market and the bond space, we've seen the bullish trend around the maturities that are on offer at the auction today, the 2035 and the 2045 bonds. We've seen the 2035 trading currently around 5% levels. There's been a reluctance from the investors to take in yields lower than the 5% benchmark. So I think that's the interest in the market today, and they don't see the rates trending much lower than the 5% benchmark on the 35. For the 2045 bond, we've seen it trading below the 6% top rate, which was at the last bond auction. So we've seen sentiments around 5.85% to 6% levels for the 45s in the market.
All right, but what's your outlook for this low yield environment we're seeing? Do you see it changing the corner anytime soon?
Oh, okay, so we've seen that from what the DMO has done so far, from the calendars they've come up with, we've seen that the borrowing for this quarter has been reduced. We have the last auction, they did between 10 to 20 billion. They actually came in and took 20 and 25 billion from the auction. But now we're seeing them come up with 40 to 50 billion, despite the maturities, huge maturities that we've seen coming to the system from the OMO maturities and most of the NTB maturities. We've seen them playing out now at the bond space. But we've seen that the DMO is quite comfortable taking this low volumes between 40 to 50 billion. We've seen them comfortable at this low yields, and we expect that this trend is going to last for a short period of time, maybe up to the end of this year, because we've seen the calendar that's come out for this quarter. And we know that in December, there's a lot of maturities also coming into the system, over 1 trillion on OMO maturities coming in. And most participants can only play in the bond space because the yields in the treasury bill space are trading below 0.3% levels on the longest tenor. So we still see the bond trading at this low yields in the current time now.
All right, but so help us understand the dynamics at play in the bond auction today.
Okay, so at the bond auction today, we have the DMO stands to roll between 40 to 50 billion on the 2035 and 40 to 50 billion on the 2045. We've seen a lot of demand in the market, so we expect that will filter into the bond space. So we expect an oversubscription at the auction. And when you look at where the secondary market is currently trading, like I said, we've seen the 2035 trading around 5%. So we just expect that the auction is going to close slightly lower than what it did last stop rate. It closed at 4.97, so we expect it to close slightly lower than that. But on the 2045, we've seen the market trade around 5.8% level. So we've seen people throw in their bids around this level between 5.8 to 6% level. So we expect that there's going to be a slight drop in the stop rate due to the excess demand in the system. There's a lot of liquidity in the system as well. We had OMO maturity of about 281 billion that came into the system, and there's no primary market option this week. So we expect those players to actually come in on the bond space to try to invest their funds now.
All right, but going into next week, we're expecting the Monetary Policy Committee to meet and make the announcement on the rates. But for you, though, looking at what has been playing out here with inflation rates at current levels at 14.23%, we're also seeing the market yields at the levels that they are playing at right now. What would you think? What do you think the MPC will decide on?
Okay, for my own point of view, like you said, inflation rate has gone up from 13.71 to 14.23. Despite this increase in the rate, we still see yields in the secondary market trending much lower than where your inflation is currently at. The DMO has also come on. Last week, they did an auction. Before the one-year bill came from 0.98 to 0.3. Even though we've seen inflation figures go up slightly, we've not seen that play out in terms of where yields are currently trading in the market. So for the MPC meeting, I think that at this time they would want to maybe sustain the imperial rates at the current levels right now at 11.5, because a drop in the rate doesn't necessarily affect where the yields are currently trading, because the yields are trading based on the market forces of the demand and supply. There's been a lot of demand in the market, real demand, and investors looking for alternatives where to place their funds right now. So that's actually what is driving the fixed income market. From now till the end of this year, I think they're going to maintain the policies. The central bank governor is quite comfortable at where the yields are in the market. They've actually tried as much as possible to force banks to lend to the real sector, and with where the yields are currently trading at. So I think it's a very good one for them right now, and the outlook, like the plans are actually working, and banks are actually going or giving out these loans at these current yields.